Welcome to a webinar on the new Insurance Contract Standard, IFRS 17. This webinar is part of a series of materials that the International Accounting Standards Board is producing to support the implementation of the new standard. My name is Joanna Yeo. I'm a Senior Technical Manager on the Insurance Project.
And my name is Conor Geraghty, and I was a Practice Fellow on the Insurance Project.
Before we start, as usual, the views expressed in this presentation are our own, and not those of the International Accounting Standards Board or the IFRS Foundation. A copy of the slides used in this presentation is available for download from our website. Those slides are accompanied with additional material.
We have discussed the core requirements for the measurement of insurance contracts in previous webinars. In this webinar, we focus on reinsurance contracts held by an entity and modifications to the core requirements in the standard for those reinsurance contracts. In IFRS 17, there are some modifications that reflect the economic features of specific contracts to achieve IFRS 17's fundamental objectives. We have previously published a few webinars on IFRS 17 available on our website. This slide shows how this webinar fits in with the other webinars on IFRS 17.
This slide outlines the topics in today's webinar. We will begin with a reminder of what reinsurance contracts are. We will then consider the requirements for reinsurance contracts held, when an entity should recognize such contracts, how to measure such contracts, including what is the coverage period, when those contracts could be eligible for the premium allocation approach, and finally, presentation and disclosure requirements in IFRS 17 for those contracts. Let's start with discussing reinsurance contracts. What is a reinsurance contract? A reinsurance contract is a type of insurance contract. We will be talking about different types of entities today. To be helpful, we will use the following terminology in this webinar. An entity that issues reinsurance contracts is a reinsurer. An entity that holds a reinsurance contract is known as a cedant. We note that IFRS 17 does not use the term cedant, but we do so today for brevity. Let's start with the reinsurer. The reinsurer accepts significant insurance risk relating to the underlying insurance contracts issued by the cedant. The reinsurer agrees to compensate the cedant for claims arising from those underlying insurance contracts. A reinsurer applies the insurance contract requirements in IFRS 17 to reinsurance contracts it issues. Now let's move on to the cedant. The scope of IFRS 17 includes contracts where the entity is the policyholder instead of the issuer, but only when the contract is a reinsurance contract.
This slide provides a high-level summary of the relationship between the policyholders, the cedant, and the reinsurer. The cedant issues insurance contracts to policyholders. The cedant purchases a reinsurance contract. It agrees to pay premiums to the reinsurer and will receive reimbursements from the reinsurer when claim events occur for those underlying insurance contracts. A reinsurance contract held may provide coverage in respect of a single underlying insurance contract or a group of underlying insurance contracts issued by the cedant. A reinsurance contract that protects the cedant for claims arising from more than one underlying insurance contract is known as a reinsurance treaty. Some reinsurance contracts require cedants to pay a proportion of the premiums arising from the underlying insurance contracts to reinsurers, and for reinsurers to reimburse the same proportion of claims to the cedant. This is known as proportional reinsurance. This webinar focuses on how the cedant accounts for reinsurance contracts held. The cedant recognizes, measures, and presents separately reinsurance contracts held from the underlying insurance contracts. Reinsurance contracts held are normally assets, whereas the underlying insurance contracts are normally liabilities. The rest of the webinar focuses on the accounting of reinsurance contracts held under IFRS 17. We will first discuss when to recognise a reinsurance contract held, and then how to measure a reinsurance contract. Let's discuss first when a reinsurance contract held is recognised. An entity measures a reinsurance contract held when it is initially recognised. The timing of when a cedant recognises reinsurance contracts held depends on whether the reinsurance is proportional or not. We will discuss first proportional reinsurance. Proportional reinsurance provides proportionate coverage for the purposes of these slides. A cedant recognises a group of proportional reinsurance contracts held at the later of 1. The beginning of the coverage period of the reinsurance contracts, or 2. The initial recognition of the first underlying insurance contract. The example in the slide shows that the coverage period of the proportional reinsurance contract held starts prior to the initial recognition of the first underlying insurance contract. Accordingly, in the example, the reinsurance contract held is initially recognised on the date the first underlying insurance contract is recognised. For all other reinsurance contracts held, that is, non-proportional reinsurance contracts, the cedant recognises reinsurance contracts held from the beginning of the coverage period of the reinsurance contracts. We will discuss the coverage period in later slides. In the example in the slide, the coverage period for the non-proportional reinsurance contract held begins before the recognition of any of the underlying insurance contracts. Accordingly, the reinsurance contract held is recognised at the beginning of the coverage period, which is the earlier date.
After recognizing the reinsurance contracts held, we now need to measure those contracts. The next set of slides discusses the IFRS 17 measurement requirements for reinsurance contracts held. What are the core measurement requirements of IFRS 17 for reinsurance contracts held? Insurance contracts are measured at the sum of two components, the fulfillment cash flows and the contractual service margin. This is also the case for reinsurance contracts held. However, there are modifications to the core requirements to reflect the economics of the reinsurance contracts held. The first component of the fulfillment cash flows is the net future cash flows reflecting financial risk. The probability weighted cash flows are brought into present value terms. Additionally, the fulfillment cash flows include a risk adjustment representing the amount of risk being transferred to the reinsurer. This added to the present value of the probability weighted cash flows. The second component, the contractual service margin, represents the net cost or net gain on purchasing reinsurance for services yet to be received. The next slide discusses the measurement requirements in further detail. Let's discuss the first component highlighted in the previous slide, the present value of future cash flows. We begin with forecasting the expected cash flows arising from the contract. To the extent the reinsurance contracts held and the underlying insurance contract is measured using the core requirements, a cedant will need to use consistent assumptions for measuring the present value of cash flows of reinsurance contracts it holds with the assumptions for the measurement of the underlying insurance contracts issued. A cedant is required to forecast cash flows within the reinsurance contract boundary. The expected cash flows within the contract boundary would include reinsurance cash flows caused by underlying insurance contracts. Those underlying insurance contracts may have been issued or are expected to be issued, so long as those contracts are covered by the reinsurance contract. In addition, the cedant will need to include the effect of any risk of non-performance by the reinsurer, including any effects of collateral and losses from disputes in the estimate of those cash flows. Those expected cash flows are then discounted using rates that reflect the characteristics of the reinsurance contracts held. That is, those rates need to reflect the time value of money, the characteristics of the cash flows, and the liquidity characteristics of the reinsurance contracts held. The rates used are current, market-consistent rates. We will now move on to the risk adjustment. The fulfillment cash flows of the reinsurance contracts held includes a risk adjustment for non-financial risk. The objective of the risk adjustment is to measure the amount of risk being transferred from the cedant to the reinsurer. IFRS 17 does not specify the technique or methods that an entity must use to estimate the risk adjustment. However, the technique and method must meet the objective for the risk adjustment.
We have discussed the measurement of the fulfillment cash flows and now turn to the final piece of the measurement of the reinsurance contracts held, the measurement of the contractual service margin at initial recognition. If expected cash outflows to the reinsurer exceed the sum of expected cash inflows and risk adjustment at initial recognition, the contractual service margin represents a net cost of purchasing reinsurance. That net cost will be recognized over the coverage period as the cedant receives reinsurance coverage. As a reminder, the reinsurance contract held is normally an asset. If the expected cash inflows from a reinsurer plus the risk adjustment exceed the expected cash outflows, the contractual service margin at initial recognition represents a net gain from reinsurance held. That net gain will be recognized over the coverage period as the cedant receives reinsurance coverage. The contractual service margin for reinsurance contracts held can be either a net cost or net gain of purchasing reinsurance for services yet to be received. In contrast, the contractual service margin for insurance contracts issued can only be the unearned profit for services yet to be provided. This represents a modification to the core measurement requirements of IFRS 17 for the purposes of measuring reinsurance contracts held. Let's consider a simple example. A group of reinsurance contracts has a risk adjustment of 750 and the present value of expected future cash inflows from the reinsurer is 4,250. Those total 5,000. In the first scenario, premiums paid to the reinsurer are 5,500. In this example, the contractual service margin, the CSM, is 500 and represents the net cost of purchasing reinsurance. This is the amount determined after deducting the cash inflows and the risk adjustment from the premiums to be paid to the reinsurer. In the second scenario, the premiums paid to the reinsurer are now 4,700. In this case, the future cash inflows to be received from the reinsurer and the risk adjustment are greater than the premiums paid to the reinsurer. The CSM is negative 300 and represents a net gain of purchasing reinsurance. This is the amount determined by deducting the future cash inflows and the risk adjustment from the premiums to be paid. The net cost or net gain of purchasing reinsurance contracts is recognized over the coverage period. That is, the period of reinsurance services are received. However, there is an exception that I will explain in the next slide. The earlier slides discussed the requirement for the measurement of the contractual service margin at initial recognition of reinsurance contracts held. There is an exception to that requirement which we will now discuss. Some reinsurance contracts cover events that have already occurred, but for which the effect is still uncertain. We refer to this sort of contract in this webinar as retroactive reinsurance. A net cost of retroactive reinsurance contracts held by a cedant is recognized immediately in profit or loss as an expense, rather than as a contractual service margin when the contract is initially recognized.
A key requirement for the measurement of the contractual service margin is the level of aggregation. Reinsurance contracts held are aggregated into groups according to the requirements on the aggregation of contracts in the standard, except that reinsurance contracts held cannot be onerous. For some reinsurance contracts held, applying the requirements on aggregation will result in a group that comprises a single contract. The IFRS 17 level of aggregation requirements starts first with a portfolio of reinsurance contracts held. A portfolio is defined as contracts subject to similar risks and managed together. A portfolio is divided into groups of reinsurance contracts held that have, firstly, net gain of purchasing reinsurance at initial recognition, that is a net inflow. Secondly, net cost of purchasing reinsurance, that is a net outflow, at initial recognition with no significant possibility of becoming a net gain. And thirdly, other net costs of purchasing reinsurance, i.e. a net outflow, at initial recognition. An entity is not allowed to group reinsurance contracts held purchased more than 1 year apart and does not reassess the groups established when the contracts are purchased. We discussed the measurement at initial recognition of reinsurance contracts held. This slide is a snapshot of the subsequent measurement of the reinsurance contracts held. Earlier, we discussed how the present value of future cash flows and the risk adjustment are measured using current assumptions at the date of initial recognition. Subsequently, the present value of future cash flows and the risk adjustment are measured using current assumptions at the reporting date. At initial recognition, the contractual service margin is measured as the amount that represents a net cost or net gain on purchasing reinsurance. After initial recognition, the contractual service margin is updated by reflecting the time value of money, by adjusting the contractual service margin for changes relating to future service, and then by allocating an amount because of services received and recognizing that amount in profit or loss. We will discuss this in further detail in the next slide. Firstly, interest is accreted on the opening balance of the contractual service margin using the discount rate at initial recognition. That is the rate at initial recognition applicable to the nominal cash flows that do not vary based on returns on underlying items. The accretion of interest is also recognized in profit loss as part of insurance finance income or expenses. The contractual service margin is adjusted by changes relating to future service. These are, firstly, changes in the present value of cash flows relating to future service, determined using the discount rate at initial recognition applicable to those fulfillment cash flows. If you remember, the present value of cash flows are measured using a current discount rate. Accordingly, the difference between using a current discount rate and the rate at initial recognition is recognized as part of reinsurance finance income or expenses. Secondly, changes in the risk adjustment relating to future service also adjust the contractual service margin. There is an exception. This is when changes in reinsurance fulfillment cash flows relate to changes in fulfillment cash flows allocated to a group of underlying insurance contracts that are recognized in profit and loss. We will discuss the exception in more detail later. Finally, the balance of the contractual service margin is then allocated to recognize the service received in the period in profit and loss. This allocation is based on coverage units, which reflects the quantity of benefits provided and the expected coverage period. We discuss what is meant by the coverage period in the next slide.
The coverage period of the reinsurance contract held is the period in which insured events to which the reinsurance contract is providing coverage can occur. This is determined by considering the contract boundary of the reinsurance contract held. The diagram in this slide illustrates a situation where a cedant holds a proportional reinsurance treaty that protects it for claims arising from underlying insurance contracts it issues in a year. Each of the underlying insurance contracts has a coverage period of 1 year. However, the reinsurance treaty provides coverage for claim events that can occur in a period of up to 2 years. Consequently, the coverage period for the reinsurance contract held is the 2-year period. This slide provides a snapshot on where the subsequent changes in the fulfillment cash flows for the reinsurance contract held are recognised. The majority of changes in fulfillment cash flows follow the general principles of the core requirements. Changes that relate to current or past service are recognised in profit or loss. Changes that relate to future service adjust the contractual service margin. And the effect of the time value of money and financial risk is recognised in profit or loss. There is an option to disaggregate those changes between profit or loss and other comprehensive income. As discussed before, there is an exception to the general principle. This is for changes in fulfillment cash flows for reinsurance contracts held that relate to changes in fulfillment cash flows that are allocated to the group of underlying insurance contracts that are recognised in profit or loss. In this situation, the change in fulfillment cash flows for reinsurance contracts held is recognised also in profit or loss, and not the contractual service margin. Of specific reference to reinsurance contracts held, changes in the fulfillment cash flows that result from changes in the risk of non-performance of the issuer of the reinsurance contract held, the reinsurer, are reported in profit or loss.
Let's now move on to the eligibility for the simplified accounting for contracts with short coverage periods. We have discussed the core requirements for the measurement of insurance contracts in IFRS 17 and the simplified accounting for contracts with short coverage periods, called the premium allocation approach, in previous webinars. We will now discuss the eligibility of reinsurance contracts held for the premium allocation approach. Some reinsurance contracts held may be eligible for the optional simplified accounting, the premium allocation approach. The assessment of eligibility for the reinsurance contracts held is independent and irrespective of whether the entity applies the optional premium allocation approach to the underlying insurance contract it issues. The criteria for eligibility for the premium allocation approach for reinsurance contracts held is the same as the eligibility criteria for insurance contracts issued. That is, a reinsurance contract held is automatically eligible when its coverage period is a year or less. If the coverage period of the reinsurance contracts held is more than a year, such a group of reinsurance contracts is eligible for the premium allocation approach if the cedant reasonably expects the resulting measurement under the premium allocation approach would not differ materially from the result of applying the core requirements. A contract would not be eligible if the cedant expects significant variability in fulfillment cash flows before a claim is incurred and a reinsurance recovery is due. IFRS 17 provides examples of indicators when the entity should expect significant variability of fulfillment cash flows, and therefore those contracts are unlikely to qualify for the premium allocation approach. Variability of fulfillment cash flows increase, for example, when there are embedded derivatives in those contracts and with the length of the coverage period. As mentioned before, we have posted a previous webinar on the simplified approach.
The next few slides discuss the presentation requirements on the face of the financial statements. As mentioned before, reinsurance contracts held are presented separately from the underlying insurance contracts issued on the face of the financial statements. Let's start with the profit or loss statement. For the underlying insurance contracts, the cedant will have to present insurance revenue and insurance service expenses on the face of the profit or loss statement. We have highlighted line items specifically relating to reinsurance contracts held using red shades. Income or expenses arising from reinsurance contracts held are presented as part of insurance service expense. They are not presented as part of insurance revenue. On the face of the profit or loss statement, a cedant can choose to present the income or expenses from reinsurance held as a single amount, that is, using a net presentation. An example of this is shown on the left side of the diagram. Or, a cedant can alternatively choose to present separate amounts for recoveries from reinsurers and an allocation of reinsurance premiums, with a subtotal equaling the single amount. That is using a gross presentation. This is illustrated on the right side of the diagram. We will go into further detail on the next slide on the requirements applicable when the entity chooses to present separately the reinsurance recoveries and reinsurance premiums paid to the reinsurer. If a cedant chooses the gross presentation, that is, to present a separate allocation of the insurance premium paid and reinsurance recoveries, it should treat reinsurance cash flows contingent on claims on the underlying insurance contract as part of claims that are expected to be reimbursed, that is, as part of reinsurance recoveries. For example, some types of profit commission. And it should treat amounts it expects to receive that are not contingent on claims from the underlying contracts as a reduction in premium to be paid to the reinsurer. For example, some forms of ceding commission. An entity is prohibited from presenting the allocation of reinsurance premiums paid as a reduction in revenue. This slide considers other relevant aspects related to the presentation and disclosure of reinsurance contracts held. As discussed before, the entity has a choice between presenting the finance income or expenses from reinsurance contracts held all in profit or loss, or disaggregated between profit or loss and other comprehensive income. The finance income or expenses from reinsurance contracts held must be presented separately on the face of the statement of financial performance from the insurance finance income or expenses from contracts it issued. The last few slides have discussed the statement of financial performance. How about presentation in the statement of financial position? A cedant will need to present a group of reinsurance contracts it holds that are in an asset position separately from a group of reinsurance contracts in a liability position in the balance sheet. As a reminder, the reinsurance contract held must be presented separately from the underlying insurance contracts. It will also need to present roll-forward analyses of the carrying amount of reinsurance contracts held separate from roll-forward analyses for underlying insurance contracts that it issues. That's the end of today's webinar. This webinar has covered high-level information on the IFRS 17 requirements on reinsurance contracts held. We hope you found it useful. As stated before, we intend to produce future webinars and other materials to support the implementation of IFRS 17. Thank you for listening to today's webinar.
Thank you.